Thank you for taking the time out of your practice today. We have got a loaded topic of discussion. We're going to be talking about the value of and opportunities within inherited monies within retirement. Before we get into the presentation today, and I bring on our expert speaker from Western Southern, Kim Humford. Before we introduce Kim, we're going to go through a couple items here on the front end with IMS and go through some of our questions here up front, and then we'll summarize it up with the topic. Again, appreciate you attending. And for those of us that are new with IMS, we're going to be going through a topic today, one of which you'll be able to integrate into your existing client orientation or onboarding process, your existing marketing and with clients one-on-one. And if you are a new producer with us, we've got a way where we can do some cost sharing. In your first 180 days with IMS, you're going to be considered a new producer with us. And during that 180 days, for every level you see on the screen here, and we'll get this emailed out to you at the end of the presentation for attending, you will get an opportunity to receive the following. So $100,000 in annuity premium. This is annuity listed currently. In your first 180 days, you have a choice between a postcard mailing, 1,500 piece, an iPad, $750 in cash, or a complete pre-formatted email marketing campaign and corporate identity package. And the sky's the limit. It goes from there. Let's say we're at $750,000 in that 180 days. We had a gentleman submit close to $1 million the other day in his first case. And in his case, he would be able to take a look at joining, possibly starting up a radio show with Retirement Boss Radio, connected through IMS, putting together 2 complete Social Security Navigator seminars, or choose between a $4,500 lead credit. Or important to note, in the case of this individual I'm referencing that was under $1 million, he had his existing marketing campaign going on. Already had his budget and expenses lined out, so we simply reimbursed for a portion of his already existing marketing. So bottom line, your first 180 days with IMS, we want to make sure it's an exciting start to our partnership here, and we're going to fund you additional monies during that time. As you move past the 180 days, you got to be wondering, well, where's the cash for writing going forward? Well, there's more. So as you continue with IMS after your 180 days, every IMS producer, we put together a marketing reimbursement account for you. The account does not expire. It does not leave. It is set up to help rocket your practice, to help leverage marketing expenses, to be able to further market your practice and get in front of more people to see. So for every $100,000 in annuity premium, we put $100 into that account. For life insurance target premium, it's $200 per $10,000 in target premium. And single premium life, $200 per 100,000 in premium. So those asset-based single premium cases will work as well. If you have a question about inquiring about your balance, talk to your primary contact or myself here at IMS. Be happy to help you out. Our back office support once the business comes in. The special shout out to my team. I have an opportunity to work with, in my opinion, the best new business processing team and contracting team that I have been a part of, and in my biased case, the industry. But everything from case design all the way through advanced case design, which is typically where I will get involved, and all the way through the forms and commissions being paid out, to include contracting. Work smarter, not harder, folks. Most of our information, you can also, to include e-applications and forms, you can get via the website 24 hours a day. So if you are interested in orientation as to how to unlock the special features in our website that you may have not known were there, let us know that too. And we'd be happy to get you a guide, send you a link of a video, or walk through personally one-on-one with you. You can access on our website things just to highlight not only the e-applications for annuities, life, etc., but also a term quote engine, a final expense engine that will list out top final expense quotes. Sales resource library, which we'll be talking today about the non-qualified stretch, as well as the qualified distributions after death, and some of the topics we'll be talking about you can access and customize to your practice. Information sheets about those topics in our resource library. We do Luma, Firelight, iPipeline, and Sunfire for our e-applications for all lines, and we're steadily adding carriers there. one of the things we're going to be at the end of the presentation, after we do get done talking about the opportunities with transfer of wealth, there may be individuals in the room that say, hey, I see this as an ongoing topic. I see this come up very often in my practice. The demographics line up. I want to make sure my community knows how much I know about this topic and how much I'm prepared to help them with things like making sure that they make the most out of their inheritance with their kids, not paying Uncle Sam instead. If you would like to highlight that and integrate that into your brand or launch a separate marketing campaign for such a thing, here is the place to do so. To include digital marketing, social media marketing, email marketing, anything you can think of, all the way down to geofencing, where we can put a digital fence around a particular company that you may know has employees in there you'd like to work with, so that when they pull up their digital marketing or Facebook accounts, they see your advertisement. So inquire if you do have a question about putting together, or maybe you want to double check your marketing plan. We can definitely work with you on that as well. If you don't have a marketing plan, or if you have an interest in going into the new year, this is one of the things that my team and I are doing quite a bit of right now, is analyzing your existing marketing for next year. A lot of topics, a lot of questions from producers. Are we keeping the same vendors? Right? Am I going to be integrating a new marketing workshop into what I do? Et cetera, have been coming up. And so we are prepared to sit down with you and have the way this works is work with you over the phone to sit down and get an idea, filling out a worksheet here for our team as to where your marketing plan is currently at. And then we will go through with your permission to move forward and make some adjustments as well as suggestions on that plan, provide you both. But here's where you can integrate exploring new marketing opportunities, create or expand your digital footprint. Like we were talking about earlier, enter in a different line of business into your practice. Speaking of which, that can often generate increased revenue. So for those of you in the room that are considering adding your Series 65 to be a investment advisor representative, we do have a corporate RIA, IMS Wealth Management, is an annuity friendly wealth management service here through IMS. And we do, in many cases, can possibly lower your ongoing fees. But for you, if you're looking at adding this license, it's an opportunity to pick up revenue that you're not seeing currently, but you're having an opportunity to touch every day. And that's the ongoing monthly revenue that comes from many of the clients' assets under management accounts. It also, as you can imagine, makes it much easier to transfer your monies into, after you've created a plan with the client, into the various products that you may use to help get them there, like annuities, life insurance, etc. So if you do have interest in IMS Wealth, let us know. We'll get you an information packet, get you on the phone with one of the gentlemen or ladies over at IMS Wealth, answer any questions you may have. And it may be as simple as, say, how do I get the testing material? If I want to take my Series 65, they can help you with that. So IMS Wealth Management, give us a call. Now the fun stuff, we have several trips going on, one of which several of them have overlapping qualification periods. So we'll be getting this information out to you here, but we have our Beachy Keen trip, which in part with IMS, we've got Athene semi-sponsoring some of that with us. March 22nd through the 25th is the actual trip, and that's out in Cap Cana, Dominican Republic. We'll go through the qualification periods here in a second. At the same time, we have our trip. SILAC has, in partnership with IMS, has a trip coming up, Park City, Utah, August 2nd through the 5th of 2026. This one, the qualification period is May through this April. And so I'll be getting a grid out to everybody that kind of shows these overlapping. And then our ongoing trip every year as an agency, where we are unique when it comes to our trip for producers each year, is we have an 18-month qualification period. So 6 million points to qualify. It's essentially 6 million in FIA premium, index annuity premium, life insurance counts, target premium at a tenth of that, and 6 million points, but you have 18 months to do it. July 1st through December 31st of 2026. And that one, the trip location, we're going to be heading out to Nassau in the Bahamas, out there where the Atlantis Resort is. If you've ever been out to Bahamas, great opportunity to rub elbows with other producers. In addition to that, right now, just ask. A lot going on this morning here, but 2 times trip points. So all submitted indexed annuity business currently November 1st through December 31st of this year, 2025, you're getting 2 times the points. So it's submitting double credits essentially for the trip. Our top 20 individual qualifiers will also have an extension on that trip, a couple extra separate days, rub elbows with each other as well in that beautiful location. We are starting up our calendar for next year for our life and annuity academies. If you have interest, please let us know. And without further ado, I'm going to introduce Kim here, and we'll get the information out to you. Before we do that, actually, I'm going to go ahead and we'll do Kim, and we'll do our polling questions here after I introduce Kim. Without further ado, Ms. Kim Humper.
That's so funny. It wouldn't be you and I, right? Without
right.
something going on.
That's right. It goes without saying it good relationships. This industry has nothing but good things to say about that. Definitely, Kim. Well, you got it. You just let me know when to hit your slide. I'll van it up for you.
All right, sounds good. Well, thanks again, Justin. I appreciate it. And everyone on the other end of the call, thanks for hanging in there with us and sticking with me through this presentation. So this is a great opportunity. I wanted to share information just on beneficiary planning for IRA and non-qualified contracts. As the title indicates, this is a very overlooked opportunity. So what I plan to do is how we're going to identify kind of what those are. We'll go through kind of some of the rules real quickly, and then we're going to reveal how you might be able to tap into some sales opportunities while helping clients leave more money to their heirs. So go ahead and fast forward or go to the next slide. This is just a really quick agenda. I already mentioned we're going to talk about the post-Secure Act landscape. We're going to outline the key rules for EDBs, which are eligible designated beneficiaries, and ineligible beneficiaries. So I thought it'd be better to kind of go over those rules, make sure you all have an understanding of what they are before we kind of dove into what some opportunities might look like. We'll also talk about the tax-efficient options for beneficiaries of non-qualified annuities and demonstrate how our annuity solutions can create more tax-efficient outcomes for heirs. And then sprinkled throughout, I'll share some sales opportunities with you. So go ahead, Justin. All right, so this is actually, these are just pieces pulled out from a marketing piece that we have. So there are a few snapshots, but they're going over some 10 rules for RMDs upon death, for IRAs, as well as qualified plans. And to make sure that financial professionals really understand the RMD rules upon death, we're gonna break them down into 10 somewhat simple rules. We're going to keep in mind that the secure rules apply in the cases of death occurring after 2019. Death that occurred before 2020, those rules are different. So we'll talk about that a little bit more. All right, so let's start with rule number 1. Simple, easy. Spouses can still continue to do spousal rollovers. Rule number 2, this limits a select group of individuals. They can still stretch distributions over their lifetime. Eligible designated beneficiaries, or EDBs, may stretch inherited IRAs or qualified plan accounts over their lifetime. And EDBs, what are they? So they are spouses. They are beneficiaries no more than 10 years younger than the deceased. They can be disabled or chronically ill persons. And then minors up to age 21. So all of those people fall into what we call, or the IRS calls, an eligible designated beneficiary. All right, moving forward to rule number 3. In general, the rules for those who can still stretch are not unchanged. Okay, so they still have their entire lifetime to take distributions. That must begin actually by December 31st. Of the year following death, okay? And it must continue at least annually thereafter. All right, so eligible designated beneficiaries, again, can stretch and take that tax-efficient options, right? That's the most tax-efficient option They can stretch those tax liabilities and annual distributions over their entire lifetime. The key is they have to begin by December 31st of the year following death of the original owner. So keep that in mind. All right, continue. All right, skipping to rule number 4. All right, this is where it gets a little weedy. Non-eligible designated beneficiaries, which is a healthy adult children, right? Because they would be eligible if they're chronically or disabled. So we're talking about healthy adult children that are subject to the 10-year rule. Most experts and commentators through the 10-year rule worked like, thought that the 10-year rule worked like the 5-year rule, right? No annual distributions, the entire amount had to be distributed by December 31st of the year that contains the 10th anniversary of the decedent's death. Wow. According to the proposed regulations under the Secure Act, the 10-year rule applies differently to beneficiaries of IRA owners or plan participants who die before their RMD or RBD date, right, the required beginning date, and those who die after. If the deceased or decedent died before their RBD, the required beginning date, any beneficiary subject to the 10-year rule must distribute the entire account by December 31st of the year of the 10th anniversary of death. So let's kind of simplify that. They can defer for 10 years. They have to take it all out on the 10th anniversary of the year following death. All right, so the 10th year after death. That is their option. They can defer it. They can take money within those 10 years. They can wait until the 10th year and then take it all out, and it all becomes taxable. However, now that we're talking about the flip side, all right, so if our deceased died on or after their required beginning date, those beneficiaries are subject to the 10-year rule, but they have to take distributions every year through that 10th year. And all of it has to be distributed at the end of the 10th year. Okay, so it's a little bit different. So if your client has passed away and they were of RMD age, your beneficiary has to continue taking RMDs. Okay, so that's where it got a little sticky. And I think everybody, after, once these rules came out, everybody kind of interpreted them a little differently. Some were really in that space. When I say some, I mean carriers were in that space kind of doing their thing on how they interpreted those rules. And others, were not doing anything. So we're still kind of finding that today. We've got some that were offering solutions to some of these beneficiaries on the IRA and qualified plan side just directly after the Secure Act. Well, now today, now that these proposed or these regulations are now better understood, they've pulled out of the game. So just be aware that there are some carriers that can offer solutions for either type of beneficiary, and there are some that can offer it for one type of beneficiary, and then there are others that just don't offer it at all. So I just want to be straightforward and fair. All right,
and
so
appreciate that, Kim. Thank you for saying that. And that is with the carriers that IMS represents, Kim's very correct. Reach out to us as you're working on any cases if it has to do with anything related to an inherited, because it is carrier specific. And my staff here, we have a internal resource that we can use to help us, that we've created here to help us with the differences between carriers. So very much a good thing to check before the case gets sent up to the carrier. So
absolutely. Yep. And then rule number 5 is pretty easy. Eligible designated beneficiaries, I'm going to start calling them EDBs because I'll start getting tongue twisted here in a little bit. They, even though they're eligible, they can still elect to follow a 10-year rule if they want. They just cannot stretch that inherited contract beyond their life expectancy. They can take it sooner. That just means that, we're paying those taxes sooner, and who gets happy from that, right? The IRS, they are happy for you to pay those taxes sooner. You just can extend it beyond their life expectancy. So these are the rules today. So while we may not be clear on how the 10-year rule will look going forward, hopefully it doesn't change or is reinterpreted, we do know that the 10-year period ends by December 31st of the year that contains the 10th anniversary of death, okay? So for example, to make that crystal clear, a death that occurred in 2022, the 10-year period would end on December 31st of 2032. So that should help. All right, we can move on to rule number 6. This shouldn't be any big surprise. Original beneficiaries of decedents who died before 2020 can continue to stretch over their entire lifetime. In fact, if they're already in a stretch status, they can actually pick that up and change carriers. They can move it, to a better opportunity. Maybe it's stretched into a MIGA somewhere else. Well, now they might want to put it into an indexed annuity. Maybe they want to put it into an income annuity. They can do that. They are grandfathered into that and they're able to pick it up and move it. All right, rule number 7. This one works a little bit differently than the successor beneficiary rules worked in the past. The successor beneficiary does not get the remainder of life expectancy period of the original beneficiary. So now we're talking about, okay, I've inherited an IRA from my dad and now I've passed away. My heirs only get the option of the remainder of my life expectancy, or in my case, if I inherited from a parent, they only get the rest of the 10 years that I had available to me. So I hope that makes sense. So again, I inherited an IRA from a parent. Because I'm a non-spouse beneficiary, I am ineligible because I'm not chronically ill or disabled. I have a limit of 10 years to spread those taxes out. If I pass away anytime within those 10 years, let's say year 5, my heirs, my children, or even my husband, they only have the remaining 5 years to pay taxes on that amount. Okay, see, it gets a little hairy. All right, so rule number 8. This one usually is a big surprise. The successor beneficiary does not get, and I kind of alluded to that, does not get a new 10-year period, but is going to be limited to the remainder of the original 10-year period. So I think I really kind of honed that in right there. All right, let's move on to rule number 9. All right, this one just states that the rules did not change for non-designated beneficiaries. Non-designated beneficiaries are estates, charities, and some see-through trusts that are typically limited to the 5-year rule if the decedent died before their RBD date. Otherwise, they have the decedent's remaining life expectancy. Now that can also get a little sticky or hairy. Each carrier is going to look at that rule a little differently. They may or may not take it. So just reach out to Justin's team just to be sure on who you might just be deciding on where you're going to send that business. We typically will, if you have a case here, well, even if it's not here, if it's a non-natural person, we will not take it as any type of inherited IRA or stretch status. So that's integrity life. And then finally, we'll go over rule number 10. This pertains to most of the rules for see-through trusts. Depending on the type of beneficiary and trust, they still might be able to stretch it, but that is something that you're going to have pre-reviewed. All right. Let's move to the next slide. All right, so this is talking about just some RMDs. I'll quickly go over this, not to bore you, because I want to get to some opportunities for you. While the rules for the RMDs upon death for IRAs and qualified plans are generally the same, there is one rule that differs, and that is the aggregation rule. We've all heard of that, right? So RMDs for IRAs must be calculated separately for each IRA. However, an individual generally may total the amount of RMDs from each non-annuitized IRA and then take the total amount from just one or more of the IRAs. You don't have to specifically take that RMD from that specific annuity or IRA account anymore. You can take it from wherever you want as long as the aggregated amount has been satisfied. So while these IRAs held as an owner cannot be aggregated with IRAs held as a beneficiary, just recall that. If me as a beneficiary now, I cannot commingle. I know we all know that word. I cannot commingle funds, kind of like you can't put non-qualified money with IRA money. I cannot put my beneficiary IRA RMDs. I cannot commingle them or add them, aggregate them to my own IRA RMDs. Okay, they have to be separate. Now, if I had inherited multiple IRAs, so I have a couple of beneficiary IRAs or inherited IRAs out there, I can aggregate those, but it's kind of, think of them as their own type of fund classification or tax qualification. I can commingle inherited IRAs and my own IRAs, but I can't commingle them together. All right, and then as for qualified plans, so that's a little bit different. RMDs must be calculated for each separate qualified plan and distributed from that plan, that separate plan. All right, so as both Justin and I had said, these rules can get pretty confusing. So this is when I want you to lean on the IMS team to determine the eligibility of a beneficiary. But especially if you're working with that non-natural person as a beneficiary, like a trust, charity, or an estate.
Yeah, thank you for that, Kim. And I don't believe any other carriers. I think most of them have that same stance on the non-living entities on the non-qualified stretch. But yeah, that conversation, ladies and gentlemen, happens really, really quick. This is, like Kim said, hairy. It can get detailed, but the good thing is you call us, explain the situation, and we can partner with great companies like Kim's team or Tim Watts here in the office. It's hard to transition between the two, but we can get them on the phone and quickly get those answers and make it seamless for you.
Perfect. All right, so let's talk about like annuity solutions on the next slide. So what annuity solutions are available for beneficiaries of IRAs? Well, I heard Tim talking about, this great trip. That sounds fantastic, right? And you get, I think you said you get a double the points when you're doing an indexed annuity. Well, guess what? For eligible designated beneficiaries, you can choose from all of our annuity solutions. And if you're not familiar with what we have an entire suite of annuities. MIGAs, traditional fixed, with a 7-year surrender schedule, flexible premium. We have income, DIAs, a SPIA or a DIA, and we have 3 actual indexed annuities that are available to you. So with this being a younger life, I see more inherited IRAs for eligible beneficiaries going into our indexed annuity. Same with the next topic we're going to talk about. Ineligible beneficiaries, 10-year payout, and our SPIA product. That is the only option that we have. That was our stance from the very beginning when these rules first came out. Like, we're only going to offer our 10-year SPIA for these beneficiaries because we were comfortable with that. It was a set it and forget it type of situation where the client would never be penalized. So we decided to go ahead, even after, I guess, the confirmation of what those proposed regulations or those regulations were supposed to be, right? Defer if they're not of RMD age. RMDs, if that deceased was RMD age. We didn't change our stance. So in situations where your deceased is of RMD age, the beneficiary that has to take those RMDs, this makes our SPIA the set it and forget it option for them. Okay, so that's where I want you to think of us, is for situations where your deceased was old enough where they had to take RMDs, therefore that beneficiary should be taking them as well. And that's where our SPIA fits very nicely. So there's no more worrying about paying any penalties on any missed RMDs. If you want to continue to the next slide, that'd be great. So what if this beneficiary that has to take these RMDs really doesn't want or need the income? This is one of our flyers, and I cut off the bottom of it just so you could see it pretty well. This talks about using, and this is actually using a lump sum in this actual flyer. But think about these RMDs that are paid out to these beneficiaries. They don't want it, they don't need it. Well, how about you considering offering a 10-pay life policy to them, or something that would provide them some long-term care coverage, where those distributions over the next 10 years can actually fund those policies. Using an immediate annuity is a great way to do that. Gives their beneficiaries and their heirs that tax-free death benefit, or saves their family from having to come in home and help them when they might need it the most, right? So maybe get them some long-term care coverage with that. And the best thing about using our SPIA to fund these type of policies, whether we're working with our client today or maybe we're working with their heirs tomorrow, we can pay that other insurance carrier directly. As long as it's set up on an annual basis, we can pay that directly for them. So there is no more changing hands from us to that other, or to the client to the other carrier. It's
That's
a
great.
set it and forget it. Mm-hmm.
I didn't realize that. So we no longer have to have them utilize their checking account. A lot of insurance carriers, as you may know on the audience, from a business standpoint, won't allow the funding of their own life insurance policies or long-term care. But then I found in general, like Kim's saying, we don't have many that will also outside of that. So it sounds like you guys will. That's great news. I'll get you added to that list. Thank you.
Perfect. Yeah. So now let's move forward. We're going to switch gears. And we're going to focus on the death benefit options under non-qualified deferred annuity. Let's see, I'm checking on the time. Okay, and then we'll move on to setting up stretches during a lifetime with non-qualified contracts. All right, so here on the screen, you'll see that there's two options right here. Those are traditionally the only two options that were available for non-spousal beneficiaries of non-qualified deferred annuities. It's a lot of words, sorry. So you'll see a lump sum or an annuitization option. Well, actually on the screen, you're going to see a 5-year deferral. So with the addition to the IRS code of Section 72S, distributions became required on the death of an owner. So in this introduced the 5-year deferral option and the non-qualified stretch. So lump sum, depends on everybody's situation. They might need the money. Maybe it's not a huge amount, but what if it is a pretty large amount? What happens when you take a lump sum? You're taxed immediately on that, right? All the gains, you have to pay all of those gains that following tax year. A 5-year deferral, I kind of consider that a deferred lump sum. Yeah, you've got 5 years to stretch that out. Again, if it's a really big tax burden, that's a pretty short time to do that. So it might not be the best situation. All right, so you could use actually, partial withdrawals within that 5-year deferral, or you could wait the 5 years and take a full withdrawal if you want, but typically not the most tax efficient option. So let's fast forward and look at the other two more tax efficient options, which is annuitization. That does use the exclusion ratio for each payment. So using it part gains, part basis calculation does make it more tax efficient than the other two options we talked about. But you lose flexibility and you lose liquidity. Like you go into an annuitization, traditional annuitization, you don't have any access to it. You're kind of stuck. So you lose all of that control and liquidity. But the fourth option is a non-qualified stretch, and it's available to a beneficiary that is a natural person. So this is a non-spousal beneficiary. So I'm a non-spouse to my dad, right? It doesn't have to be parent-child. It can be brothers, sisters, aunt, uncles, friends, neighbors, partners. It doesn't matter who it is. They are not married. They are non-spousals. And this non-qualified stretch option allows these non-spousal beneficiaries to take a distribution of the death benefit over their entire lifetime. It allows that Benny to withdraw the minimum amount each year. And unlike the traditional annuitization option, It allows that beneficiary to withdraw more if they need it. The beneficiary is the owner of that contract, he's the annuitant of the contract, and has complete control of it. The first distribution on non-qualified stretches does need to be taken within 1 year of the owner's death, and they have to be taken at least annually. So think of those just like an RMD. They have to start within a year of the owner's death and annually going forward. Some carriers require that the decision to take the non-qualified stretch option must be made within 60 days of the date of death, even though the first distribution can be delayed up to 1 year. That is going to vary based on the carrier. We're a little bit more lenient here at Integrity Life and National Integrity Life. Just saying. There are separate account rules. Go ahead, Justin.
There. Selfless promotion there, but no, it is true. Yeah, we appreciate you guys for being able to do that. For sure.
Absolutely. So there are some separate account rules that apply when there are multiple designated beneficiaries under one non-qualified annuity contract. That just basically means each beneficiary can choose their own option. So maybe I chose a stretch, but my brother wanted a lump sum. Maybe another sibling wanted the 5-year deferral. Maybe they wanted to annuitize. Each one of us can choose whichever option works best for our scenario. I know I think gone are the days, I shouldn't say they're all gone, but I think most of those days where each beneficiary had to choose the same option, I think all of those are gone. I don't think we even have any annuities on the books that were filed that way. So it's a good thing to kind of check with your carrier as well, where the current carrier holds that actual annuity. All right, so let's fast forward to the next slide, and we're going to talk a little bit about, is that one blank?
No, it's interesting. It's got, let's see. Oh yeah, I'm going to go ahead and load them for you.
Oh, there you go. I didn't realize it was like that.
There we go. It's automated. Oh, that happens to me too.
That's
Sorry.
So funny.
You want me to back it up? You want to?
No, you're good. This is our advanced market slide. So yeah, I didn't realize there was animation in there. They're always throwing something in there to throw me off. All right, well, let's talk a little bit more about the non-qualified stretch before we move on, because there are some things that you need to be aware of, and that is not all carriers will offer a stretch. And those that don't may allow a tax-free 1035 exchange to a carrier like Integrity that will allow a stretch and accepts a post-death 1035 exchange. Did you get that? All right.
So this one may catch their attention. If they don't, there's often the case where you may not be able to get an additional commission too by moving the money outside of the carrier.
Right.
But I'll let you sell that. There you go.
All right, so let me put that in just plain words. All right, so not every carrier out there recognizes a stretch. They do not allow it to move from that carrier to another carrier and retain that tax deferral. Now, and I work with Justin and his team pretty closely on this. There are specific words that you need to say to these other carriers. If you call them and say, hey, and there's a whole like training or educational type of series that we can even do, Justin, if you've got a group that want to go through it. But if you are in a situation where you've explored like, hey, I'm working with the beneficiary now, you call, or maybe you're working with a client now and you call that carrier and say, hey, you know, when my client passes away, what are the options to their kids? They might tell you a couple of things and you just might need to just reiterate. Does that mean, do you offer a post-death 1035 exchange? Meaning, will you allow that money to move and retain that tax deferral? You cannot say, do you allow a non-qualified stretch? Because I guarantee you that most of them, if not all of them, do not really know what that is. So, yes, we've all, well, you and I have experienced that for sure.
Yes, indeed.
So the key point of this is working with, there's a couple of steps that I actually recommend, but the key point is not all of these carriers allow that money to move. But we will accept that money if you can find a carrier that will allow it to move. Even in-house, you've got a client that passes away with a contract here at Integrity Life. Well, we will allow that beneficiary to do a non-qualified stretch into their own contract. So we'll accept it before these transfers before death and after death. Before death, meaning work with your clients today. I'll talk about this a little bit more, but work with them today. Is this legacy money? Yep. Okay. You want the most tax efficient options for your kids, right? I sure do. Well, let's call your carrier. Let's find out what options are available to them. If they don't have something like a stretch available, then that's when you might consider moving that money to a carrier that will actually offer that to their beneficiaries. With it being in-house, it kind of even streamlines that process quite a bit. And like Justin said, you can move it today, get paid today on maybe that older life. When that client passes away, you're working with a much younger beneficiary. When they stretch, you'll get paid again on that younger life. And like I said before, a lot of these stretches we see go directly into our indexed annuities. All right, so that was going to be my word of caution, that not all carriers allow non-qualified stretches or AKA post-death 1035 exchanges. All right, so just be aware of that. And unlike RMDs on the IRA side, which have pages of regulations available to them, there really aren't regulations under Section 72S. Carriers have the code language itself and a few private letter rulings for guidance regarding non-qualified stretches. And it allowed us to kind of say, hey, you can satisfy these requirements using one of three methods: RMD, amortization, or annuitization. Well, we took the stance of annuitization, and that provides the most benefit to the clients. That is because we're applying an exclusion ratio to these mandatory distributions. So it's an annuitization without being annuitized. So that's how we're going to treat it. The beneficiary, now owner, controls that entire contract. But every single year we're going to recalculate that, and we'll apply that exclusion ratio per gains part basis calculation every single year. So in a nutshell, as a best practice, you might want to review those non-qualified annuity contracts and carriers and consider moving to a stretch-friendly carrier prior to death of the owner annuitant of the contract. Otherwise, if your client passes away and it's sitting at a carrier, I don't know, down the street, and they don't offer that stretch, well, that beneficiary is going to be locked into either a lump sum or a 5-year deferral. Sometimes they might offer an annuitization, okay? Annuitization is the most tax efficient of those three. All right, so let's go ahead and move forward. I think I've kind of pounded that into the dirt a little bit. All right.
Did you cover this slide, Kim?
I did not. No.
Okay, it was one after the.
Yeah, so this is just another private letter ruling that permitted a non-spousal beneficiary to do a 1035 exchange into an inherited non-qualified deferred annuity. So this is just one of the rulings that helped us to kind of determine, hey, if there's a private letter ruling out there, I mean, what does a private letter ruling do? It's not like it's that person's or that whoever holds that PLR, it's their interpretation of how they're going to treat this going forward. So we are kind of using that information to actually to support our stance on why we chose the annuitization. And that's basically what that is. All right, so let's talk about the tax deferral. Let's kind of look at it side by side. So time can be a force multiplier, as we can see here on the screen. In the orange bars, we see the impact of the lump sum as well as the 5-year deferral. The life annuitization and the non-qualified stretch are, running side by side. But this would be based on maybe a 39-year-old beneficiary. I feel like beneficiaries that we've been seeing are a little bit older, but it's still the visual is the same. The annuitization and the stretch potentially spread out the income and taxes over that beneficiary's life expectancy. A 39-year-old has 46.7 years to take that money. And so that's pretty lengthy age. The stretch offers the most flexibility than the annuitization. And non-spousal beneficiaries not only can stretch over the lifetime, but then they can also take more income as needed. So they don't have to be held to that required mandatory distribution. They can take more if they need it. So if we've got time, I want to go through just a really quick scenario on the next slide. This one just demonstrates the stretching of payments and taxes over a beneficiary's lifetime, which takes into account that time value of money that we saw on the previous screen. All right, so in this one, Sarah's father is the owner annuitant of a non-qualified annuity. At the time of his death, the value of his annuity is $500,000 with a basis of $250,000. So half of it is gains. Sarah's 55 and married, and the couple's annual taxable income of $100,000 puts them into a 22% income tax bracket. So you, as a financial professional, would actually discuss the different distributions, right? What do we have? I wish I could hear them. Lump sum, 5-year deferral, annuitization, and non-qualified stretch. So the choice could mean tens of thousands of dollars in future value. So we'll fast forward. I'm not going to go through all of these assumptions. Let's jump to the next slide. All right, so assuming on those assumptions, I think there's some animation on that one too. And the tax values that were in the other slide, which really aren't important so much. It's looking at the tax efficiency, right, of what a non-qualified stretch might offer those clients. The value of the non-qualified stretch account and its distributions total about $813,500. As you can see in the chart, the future value of the 5-year deferral account value and future distributions, in 15 years is only $683,400. So the lump sum distributions even less. Okay, that's lump sum then reinvesting, $657,000. So, remember, refer to that chart with those orange bars, time and the tax deferral, right? So let's fast forward to the next one. When you're considering the non-qualified stretch options, don't overlook the advantage of that exclusion ratio. I talked about it, part gains, part basis calculation. In this situation, year one, that distribution is going to look like $16,456 for Sarah, but only $8,544 of that is going to be taxable. Okay, so she's paying taxes of $2,136 on that distribution. The last in, first out taxation that maybe other carriers are set up to provide, it's all going to be taxable. So $4,114 is what they're going to pay. So we're going to cut the tax bill in half on that one. Taking more than the required amount with us at Integrity, because we are applying that exclusion ratio. If you need more, that is going to break that exclusion ratio, and it's going to then be triggered or treated as last in, first out taxation. So if you are working with someone, and Justin, this might be more for you, your team, and the audience, if you're working with someone that thinks they might need to tap into it and need more income, maybe split it up into 2 different contracts. Use one to really get that tax growth or get that growth and the tax deferral, and then use the other one to actually take some distributions out of it. So the whole thing isn't broken.
Thank you for that. That's a good idea.
Yeah. So on the next slide, I just wanted to share, what are the opportunities for non-qualified stretches? Well, non-qualified stretches are limited to some of our products. We don't have our full suite available. We do have a return of premium, traditional fixed product available, as well as all of our index of products will actually offer a non-qualified stretch. So I just wanted to let you know that we do have some very nice options available. And the opportunity for you is, why wait to only hope to work with a beneficiary? You need to work with your clients today before it's too late, before they pass away at another carrier and they are locked into, the bennies are locked into a lump sum or a 5-year deferral. You can reposition those annuities for your clients, maybe bring them to a carrier that offers a lot of features that older clients like, immediate access of 10% every year, waivers of surrender for terminal illness and nursing home confinement. And then, it's here for the client, and then it's also sitting here in-house with all 4 options available to that beneficiary. And remember, IRAs, you'll need to determine their eligibility and the options available in advance. If your beneficiary doesn't want or need the income, provide them with that tax-free death benefit that they can pass on to their own heirs, or provide them with some type of long-term care coverage. Non-qualified contracts, definitely, while your clients are alive today, explore current carrier options, either new carriers, other carrier options, and discuss the non-qualified stretch option with that Benny. More tax-efficient lifetime distributions is what they're going to get. What they'll get with Integrity Life and stretching with us is we're going to give them more distribution options. We're going to give them opportunities for future growth. We're going to give them the most tax efficiency because of our exclusion ratio calculations, because we're going to give it annuitization treatment while still retaining control. And what this will do is if you move now while the client is living, you can guarantee that the stretch option will be available to beneficiaries later. And let's close it out with this next slide because this is super important. In conclusion, okay, so we've covered a ton of information for both legacy options on IRAs and non-qualified contracts. The goal isn't for you to remember all of these nuances, right? Because that's what Justin and his team are for. You're going to reach out to Justin and his team. You're going to share that situation with them, and then they're going to help you to understand what is available to them. The goal is to help you understand the opportunity, an opportunity that someone else might share with your clients and build that rapport with their heirs if you don't. The opportunity is $124 trillion. $124 trillion is expected to transfer to future generations by the year of 2048. So you need to incorporate discussions on legacy planning into your clients' meetings today and get your piece of all of that $124 trillion started today. And I couldn't, if you want to fast forward to the next slide, these options are available by a highly rated carrier, A+, 95 Comdex. We are US owned and operated. Our sales team, if you or your client call, we handle all of the calls, no matter what the situation is. So we'll give you that elite support. We are mutually held, all sitting here in Cincinnati, Ohio, and we've been around. We have a very long heritage that dates back to 1888. So Justin, I want to thank you so much for this opportunity. This was a lot, and I know we got like 1 minute to close, so sorry.
Oh no, you are fine. If I could continue on with what you've offered, I appreciate it. Yeah, to summarize, you've gone. One of the things that we're doing right now is with a lot of our producers, we're reviewing their existing annuity contracts. Let's face it, the pricing environment is ripe for updating a client in many cases, like we saw earlier. In many cases, income. You may have an existing annuity that's been enforced for less than 5 years, or right at 5 years. Even with surrender, we may be able to get them a pay raise in retirement. And so with that comes also just reviewing the tax implications within each one of your households as it relates to what tax bill or what burden would you like to, or what burden are you passing on potentially to that next generation. And I know with my parents being baby boomers, me being Generation X, this conversation, it is coming. If you haven't seen the wave yet, it's coming around a street corner near you, because I've got everybody in my peer group is asking about this, and it makes sense. We're now at the age where we're caring for many of our parents from a care standpoint, but these meetings can be powerful. You simply meet with your client, and the concept there, or a new prospect, is let's take a look at your existing insurance contracts, annuities, but in your qualified and non-qualified monies. because nowadays it pays to have a plan as far as how those are going to distribute to make sure we maximize the tax efficiency. To make no mistake, like Kim mentioned earlier, the IRS unfortunately is not our friend in this case. And it looks like in many cases, regardless of which side you believe on the political line, they're passing the burden on to our children with some of these tax increases going on, and also reduction of the stretch. So this can be beneficial when you call. If you have interest in doing those reviews with your clients, I've got a kit put together complete with information from Western and Southern that Kim has provided us. For those that get appointed with Integrity Life or contracted, just request the link to be sent to you today. We'll get that out to you, and then we'll send a kit your way, and also set up a phone call with you to answer any questions or go through a strategy with your book of business to mine those opportunities and have those conversations with your clients. So Kim, thank you so much for your time. Your help allows us to do that, and we'll be talking with you, I'm sure, as we go forward. Let me get a couple poll
Sounds great.
questions. Yeah, thank you. I'm going to go ahead and we'll with the technical issues that we had earlier, I'm going to go ahead and leave the polling questions here for email. So let me leave you here with this. I'm going to reach out. We're going to reach out to each one of you, and I'll be sending some information on the presentation as well as a copy of the recording. And I'll have a reply in there. Just reply back to the email. Let me know if you'd be interested in the kit, and that will allow us to get the link out to you prior to even the call. So you can be first come, first serve. And appreciate everybody attending today. Have a great one, Kim. I look forward to speaking with you soon. And thank you again for your partnership and friendship here with IAMS and myself.
Yeah, thanks so much.
You're welcome. Have a great day. Thanks.